right, talk about living history, trying to just make a dime in some cases. Dom Chu, we're talking options. What do you have?
Well, let's keep the excitement going with regards to Hewlett Packard, because we heard the fundamental take, the problems, issues, the turnaround efforts from Corey Johnson. Now let's talk about what traders think about the earnings report and how it's going to play out. So let's go out to Chicago at the CME Group. That's Larry Shover. He's the CIO at SFG Alternatives. And Larry, we heard Corey talking about some of the fundamentals, the management, what the issues are. So talk to us about the trader take. What's important about HP's report, and how are you going to play it?
Well, I think, again, the traders are looking for them to beat again. As you know, they've beaten 4 times in a row. Options are implying cautious optimism. That's why I'm looking at the perfect trade to fill that void. A naked put, selling June 20 put with the stock trading at 21.35. You can sell that for 58 cents. That gives you $2.51 of profit potential for the stock. But, Dominic, it doesn't go without risk. Keep in mind that if you sell that put, you're intuitively or might end up buying that stock at $19.42.
Now,
on the other hand,
Larry, just wait a second, because what we're showing viewers right now is the chart of your trade. In essence, what you're doing, you're selling a put. What you're hoping is that you collect the premium. That's the maximum amount of money that you're going to make here. The stock goes up or stays static. But if it goes down, you're going to have to make good on that insurance contract you sold to somebody else. You got to own the stock at 20 bucks a share. Talk to us about the risk-reward thinking from your standpoint here.
Well, you know, the risk-reward standpoint is I love talking about the risk of a trade because there's an option for every scenario. Right now, implied volatility in Hewlett Packard is slightly elevated. It's not that much, but on the rich side of history. With that, it makes sense for people who are cautiously optimistic about the stock to sell a put naked right now, especially in June with a month ago. You can sell the premium for 58 cents. It gives you a good play on the stock. On the other hand, if the stock should rally, you're giving up an opportunity cost. Anything above $21.93, you're better off buying the stock.
Why pick 20 as your strike price for that downside put that you've sold? Why is 20 important?
Yeah, well, we're looking at the skew in the equidistant calls and puts in all months in Hewlett Packard. It seems like $20 is that sticking point where the stock bounces off of. $19.75, $20. You're seeing a lot of open interest in all the put strikes going out there on the $20 strike. It makes a lot of sense right now.
Gotcha. So that's the trade on Hewlett Packard going into earnings. You're cautiously optimistic. Sell some of those downside puts. Larry Shover, thank you so much for bringing us that view on Hewlett Packard. Now, viewers, bottom line on this options update, Larry Shover, CIO at SFG Alternatives, is playing HP with an earnings.